Well, hello everyone. Welcome to Trading Covered Calls and Short Puts. If I am grinning like the Cheshire Cat, it is because this is going to be the last class that I teach this year. And we have got a jam-packed agenda for you. The first couple of stocks that we are going to look at have been sponsored by the letter A, but we are going to look at buy right covered calls today. And we're going to look at why a trader might consider this strategy. And there are a couple of different reasons. And so we're going to look at some of those different reasons that a trader might consider using this strategy. And then we're going to play some example trades. And we're going to look at both higher dollar stocks that you might put in a larger account. And then we'll do one that might meet the criteria of a smaller account. So we're going to look at a bit of both. If you are not following me in the land of X, I invite you to do so. My handle, Barb Armstrong CS. Brent Moores is with us in the chat. He's a friend and fellow coach. He's posting some great stuff over on X as well. So you'll want to check him out and follow him as well. His handle at Brent Moores CS for Charles Schwab. So let's get through our important information so we can get out to the platform and start discussing this strategy and how different traders might look at it and look at the reasons that a trader might consider this. You know that options include a higher level of risk or a high level of risk and aren't suitable for all investors. You also have to meet certain requirements in order to trade options through Schwab, and not all will qualify. We use the Paper Money software application on the Thinkorswim desktop platform, and that is a brilliant place to learn, to become familiar with the platform, to make sure you understand a trading strategy before you consider trading it in your live account. One of the differences that is important with this buy right covered call strategy, where we're both buying the stock and selling a covered call, is that in Paper Money, you will never be called out early. And so it's important that we understand that if you sell a call, you can be called out at any time. Okay. So it's important that we understand that, and that all investing involves risk, including the potential risk of loss. Okay. So let's come and have a quick look at what's going on in the markets. And for that, let's kind of back ourselves up and look at kind of the year at a glance. We are up 25% on the S&P. And, we had a few days of a pullback, and one day where it seemed that we were in a free fall when the market, the Fed announced their rate cut of 25 basis points, which I think people were expecting, but the commentary that came with it, had people a little upset. But, we've bounced. We had a bullish engulfing pattern at a support level on Friday and moving to the upside today. So I'd say this is, one for the bulls, both short term and longer term. Yeah, Erica is saying, I'm trying to understand this bit about being called out early. I'll explain it. It's something that isn't maybe intuitive when you first start into all of this. So the NASDAQ is in the lead of the four major indices, up 27.7% year to date. And again, pulled back last week, hit a new all-time high back on December 16th, and, came back down to the 30-day moving average and bouncing again today. So pretty bullish on that index as well. How about the Dow? Well, the Dow's in third place. It's up 13% year to date. And this, had about 10 down days in a row, and came all the way down to the 100-day moving average. So blew right through the 30, which had some people, understandably concerned if you were in the bullish camp. But it seems to have found a support level and is moving again to the upside. And 13%, nothing to sneeze at. So it's been on an upward trajectory. And the Russell, our small cap index is in last place out of the four, but still up, 10% year to date. It's been kind of consolidating, broke out above this 2300 level, and then has come back down into kind of this wedge pattern. So we'll see what it does from there. And then if we look at our volatility index, We're at 1744, but we went up over 30 last Wednesday. Our high on that day, I think we went over 30. Sorry, our high was 28. But we were down around 15. So to go from 15 to 28, I mean, that index almost doubled in a day, which is quite extraordinary. But it's come back down, indicating a pretty reasonable level of confidence. And then if we're looking at sector strength, and we're going to switch our gadget here to our watch list. And I'll just close this for the moment. So when we look at our S&P 500, and this is just a public sector watch list, we can see that in the last 3 months, which sector's been strongest? Consumer discretionary. So just hit a new all-time high last week, pulled back on Wednesday, and then has been finding its footing and moving back to the upside since. Communications, same thing. And technology. All have hit all-time highs within the last week or so. And these, stocks have really been leading these sectors. So let's start actually with love. Not LOVE, although that is a good 4-letter word. Let's start with Southwest Airlines. And what we can see here is this is a stock, it's up 16% year to date, but it's kind of been on the struggle bus, hasn't it? Yeah, it's been in this basing pattern. And some might look at this and call it a bit of a cup and handle, or maybe a sloppy inverted head and shoulders type pattern. And by sloppy, I mean it didn't come all the way back up to this line, and then it came down and came up again. And, and now it's broken out, came back to retest, and then pulled back again and is now moving to the upside. Now, it recently hit this high of 36. It's currently trading at 33. And, we call this an inverted head and shoulders pattern. Some might call it a cup and handle pattern. But the way a technician would measure it, or a chartist would say, if we've gone from, say, I'll round up to 24 just to make the math easy, to 31, they'd expect maybe about a $6 move. So from 31, maybe up to 37-ish. So let's say you're just looking to make some extra cash. You don't necessarily want to own love for the long term, but you could see for the next, month, perhaps, this stock going up. Okay. So if you're in that camp and you said, okay, we're going to come in on a shorter time frame now. So if I look at this, and we can use a covered call a couple of different ways. So could we come here and say, sell a call at 35, sell the 35 call out in January with the goal of being called out? So what do I mean by that? Well, I mean, ideally, what it would be ideal in my books, this is how some traders might think, is if I think this is going to continue to the upside, and I'm thinking this could go up to maybe 37, if I sell a call and I'm right, and it continues to go up and goes through my call, and I'm called out, what will happen? Well, I would make the difference between the 33.72 and the 35, plus I'd get to keep whatever I sold that call for. Okay? Okay. And how much might that be? Well, let's come to the trade tab and see. So if we look out January 17th, that's 25 days from now, and we look at this 35 call, now this is an inexpensive stock. So this is one, we have a smaller account class that I teach. We can have a position size up to $5,000. So we could afford to buy 100 shares of a stock that's trading under $50. Now, one of the questions might be, if you're looking at an example trading plan, does this stock trade more than 1 million shares a day or more? Well, it's already traded 2 million shares today, so the answer would be yes. Then the next question somebody might ask themselves, they might say, well, what is the volume in open interest like? Like, how many contracts are on the books at this 35 strike? 14,000. So if I sell my covered call and I want to buy it back, you think I'm going to struggle? I think I have it's a pretty liquid market, at least currently. And then what is my probability of it being in the money at expiration? 32%. So that means I've got a 68% chance that I'm going to get to keep this $61 to $64, and I'm not going to have to sell the stock. But there is a 64.8% chance that it could go above that at some point in the proceedings between now and January 17th. And at any time, we could be called out. Okay. So how much could we make on this trade? What's the most we could make if we are called out? So we're going to come to buy covered stock because we're both buying the shares and selling the stock. The most we can make is the difference between that 35 strike that we're selling and this 33.10 that we're paying to get in. So that's $1.90. So the most we could make on this is $190. So $190 is the most we can make. And we're going to divide that by the 3,310 that we're paying to get in. So that's a 5.7% return potentially in 25 days. Now, what if news came out on Love and it gapped up tomorrow and somebody called us out? Would we be sad? No, we'd be doing the happy dance because we just got paid that $35 and we now have our max gain on this trade in 1 day instead of 25 days. So the most we can make on this if we bring up our confirmation page is $190. Now, how much could we lose? Well, if Love went to zero and the net that we're paying to get in is 33.10, we could lose 3,000. Now, in this account, we don't want to risk more than 500. So we might say, well, you know what? Here was our recent low, 32.35. So let's put a stop, say 3% below that. Or you might say, well, this was acting as a ceiling, became a floor, old resistance became new support. So if I want to give it a little more latitude, I could say 31.45 we'll use this as our support level, and we'll make that times 0.97. So we would say if it goes below $30.50, we want out. So how much are we risking if we put in an exit at $30.50? About $300. Is that less than 500? Yes. Now, how do we put in an exit? Because we don't know exactly what that covered call is going to be worth. We're going to change our single order to first trigger sequence down here under the advanced order category. And then we're going to right click, create an opposite order. We're going to make it a market order because we want to exit, make it good till canceled, because we want to exit only if this goes below $30.50. $30.50. Yes, we will reset the account on the 3rd. So as somebody's saying, any concerns when they pay a dividend? Well, the stock will probably drop a little bit in price. But if the dividend being paid, the dividend is 18 cents. If it drops 18 cents, will that trigger our stop? No, it would have to drop almost $4 for it to trigger our stop. So we would be good. So we're going to put this in our buy right covered call. Again, with a stop loss, there isn't a guarantee. If this gap down tomorrow, we could be out for less than we were expecting. Have I ever seen that happen? Yes, I have. You know, but we're doing what we can to manage our risk. Okay? Okay. So there's our first example. Now, let's come and look at Apple. So Apple is hitting a high today, and we might say, you know, I don't have Apple in my portfolio. We can't afford to put it in our smaller account portfolio because we only have 10,000 available. And in order to do this strategy, we need to buy 100 shares, which is a $25,000 position. So we're going to come over to our larger account where we have $500,000 sitting in cash. And we're going to say, well, I'd like to buy Apple. It looks like it may be setting up to pull back for a few days. But if I look at this stock and I think, well, if I buy it and it only goes down for one day and then continues on up, I might be glad that I'm in it. If it continues to trade between 255 and 245 for a month or so, I could buy 100 shares, sell a covered call at maybe 260. And if it doesn't go above 260, then I've made some money while it's going sideways. Okay. So how much could I make? That's always the question I'm going to ask myself. So, or that a trader might ask themselves. So they might say, okay, if I come out to the 260, you know, I get paid $2.41. So, you know, like we thought that, excuse me, the love wasn't that high, but it was actually closer to 2%. This is a bigger number, but it's closer to 1%. But we're looking at the 260 strike. So, you know, we'd make, if we were called out, you know, we'd make $6 on the stock because that is possible. Plus, we get to keep this 247 to 250. You know, does it trade more than 1 million shares a day? Absolutely. We're at 19 million shares. You know, when we look at this 260 strike, do we have at least 20 times the number of contracts we're going to trade? Almost 80,000 covered at 80,000 calls, you know, have been bought and sold. Like 80,000 contracts are on the books. Another, well, 79,913, another 4,496 have been traded today. So if we look at this and we look at the probability of it being in the money, this is saying 32%, a 63% chance that it'll at least go through it at some point between now and January 17th. So if we look at this and we say, well, we're not necessarily trying to get called out, but we know that that is part of this strategy. And if we are called out, we're okay with it. If the stock goes sideways for a while, we could let this expire worthless if it's not in the money at expiration, or we could buy it back, say for, you know, when we have 80 or 90% of our max gain. If it comes back to the support level, we might say, hey, if it comes back to the support level and we have 50% of our max gain, we'll buy it back and then sell another one when it rebounds. And so we could do a wash, rinse, repeat. So if we look at this and we say, okay, how much can we make? It's trading at 251, let's call it 251.70. The most we can make is 260. So if I take this 260 and we subtract our 251.70, which should be about 830. So $8.30. Well, is that a good return? Well, if we divide it by our 251.71, like that's a 3.3% return. For a trade, we'd be in for 25 days. Now, Apple, the premiums aren't super high on these covered calls because it's not considered to be a very volatile stock. So we're actually getting a bigger return percentage-wise on Love, even if the dollar volume isn't as high. But the most we can make on this is 827. And we're saying we recognize that the stock hit a new high today. And so it could be about setting itself up for a pullback. And if we've sold this call, then, it's a way to kind of ease the pain of the depreciation in the value of the stock if it makes a short-term pullback and maybe make a little money as it's doing that. But if we are called out, are we okay with it? If you're not okay with it, then you shouldn't place the trade. You shouldn't sell the covered call. You might say, I'm just going to buy Apple and add it to my portfolio. But if we look at, if it's here at 255, if it came down to 245, let's say it came down to 245 on January 3rd, because this expires, January 17th. So let's come to the trade tab. And we are going to come to Theo, Price, and Mark and say, okay, what if the stock pulled back by about $10 a share? So the first thing you do is hit reset. So today's the 23rd. We're going to say, if this went down by $10 a share by January 3rd, okay, what would this option be worth? Kind of a ballpark. Saying, well, this option that we paid $240, we were paid say around $254, would be worth about 10 cents. So could we buy it back? Well, sure we could. Sure, we could buy it back. And then if it, so if it comes down, and I'm going into more detail on this because there are some people on this webcast today that are kind of newer to this strategy. So let's kind of walk through this. So we sell our covered call today at 260. So we have a buy right covered call that we've sold. That's going to show up on the line anyway at 260. And so let's say the stock pulls back. So it pulls back, it comes all the way back to this 245 level, and then it bounces. And now this thing that we paid 250 for, we were paid 250 for it, it's now worth 10 cents. So could we buy it back? Yep, we could buy it back. And then let's say the stock bounces and comes back up again. Well, could we now sell the 260 again? We could. So we could sell this 260 again, or maybe even sell the 265. And we know that we could be called out, but if your goal here is to generate income, you aren't necessarily using it as a long-term buy and hold. And sorry, I should have made this 260. That shows our strike. So, if it comes back up here again, could we sell another one? And, I kind of call that wash, rinse, repeat, and I'm not the only one that does that. But it's another way of looking at this. Does this make sense? Are there any questions on it? So let's see. This one hasn't filled yet. So we want to pay $251.73, and they're saying, yeah, well, now we want $251.82. So if we wanted, we can come here, cancel and replace that order, and say, okay, you know what? We'll give you $251.85, no problem. And again, can we put an exit on that position? Sure we can. Okay, So now we're in Apple. Let's look at AVGO. So AVGO is up over 100% this year. Like, holy smokes, it's been rocking. And it was kind of consolidating here, and then it hit earnings and it went nuts. So we have this big bull flag, then it pulled back for 3 days. Had an inside day on Friday. We saw a lot of this type of pattern on Friday, and then it moved to the upside. Okay, it's moving to the upside again. So could we say, you know what? I've got now still $500,000 sitting in cash, not working for me. I'd really like to go to Prague. So I'm going to start a little vacation fund to go to Prague. And so how much could I add to my vacation fund if I took, bought 100 shares and then sold a covered call at maybe even like 240, like kind of in the middle of the road where the expectation is that I'm going to get run over? So the goal is to not own it at the end of this period. And if it goes up, way beyond, like, are we okay with that? Yes. Now, if we sell the 240, is there a higher probability of getting called out than if we sell the 250? Probably. But we could make $10 more a share if we sold the 250. We could. Well, let's go look at it. Yeah. So Joel is asking how to set up the red bars of information, this stuff. Yeah, I'll show you that. There is a trade management mini series. I also have it posted, the script for how to add that in the post pinned to the top of my X feed. But, and this is one of the reasons you want to subscribe to the channel. So let me just bring something over here. Let me see. Okay. So if you come and just bring up a new window and type in Trader Talks. And this is Trader Talks on YouTube. If you subscribe, hit that button in the bottom right corner. But when it first comes up, you're going to see the class that's happening now. When we come to playlists, though, if you scroll down to these mini sessions, and I have created, and they're all listed at the bottom, these Thinkorswim tips, customizing charts. I show you how to add that script in this 10-minute video. Also, there's one just dedicated to adding scripts, both to watch lists and to charts. I have one on customizing the monitor tab. There's a whole bunch of little videos here. So, that's a great place to check out if you're newer to, all the stuff on Thinkorswim. The other thing that I haven't done it yet, but I had promised it would be my next example trading plan is an example trading plan for buy right covered calls. And you'll see that in this blue list here. Okay. So stay tuned to watch for that. Okay. So with AVGO, let's come to the trade tab. And of course, what's first question? First question is, does this trade a million shares a day or more? Well, we're at 25 million, so I think we can safely say yes. Then if we come to our volume and we come and we say, well, we were looking at what? The 240 or the 250, because it's trading at 232. So if we look at the 240, we've got 8,000 contracts, 8665. 3,600 contracts. Volume means the number of contracts traded today. So do we have lots of volume on this stock? Yeah, tons. And then is the bid-ask spread tight? And we want that to be less than 10%. It's 10 cents. And what is this saying? At the 240 strike, you have a 38% probability of being called out, a 78% chance of it at least touching, If we come to, well, we could do the 245, we've got thousands of contracts, a 64% chance of it touching, and we'd be paid 580. But you'll notice that the volatility, which is this number here on AVGO, is double what it was on Apple. So our premiums are juicier. So if we said, well, what if we went between the 240 and the 250? Now at 250, we'd still be paid 445. We have 23,000 contracts there. And if you're saying, well, I wouldn't mind just owning this stock, and if I get called out, I'm okay, but I'd rather have a lower probability, then if we look at the math on this, we're buying covered stock. So if we were to be called out, and the probability is lower because we're going for a strike that is further away, so it would have to move up $18 for us to be called out. But were that to happen, how much would we make? Well, 250 minus 228 is $22. And I'm rounding, but 22 divided by 228, that's a 9.6% return. Now, what if instead of we could still make about $15 or $1,500, and that's divided by 225. That's a 6.7% return, but there's a higher probability, about a 5% higher probability of it being in the money at the 240 than at the 245. Or 245, 240. Where you go from, here's our 240, a 37% probability, to the 245 is 30. So you just have to decide what you're comfortable with. And if you're saying, well, this stock is up over 100% year to date, I'm okay with owning it longer term. I'd rather sell something at this 250 strike. Well, this is your example trade. You can do it however you like. So if we sell the 250, now where might we put a stop? We want to manage our risk. Well, we might say, here's our recent low, was right around here. Like if we hover over this candle, it was at 217.58. So if we take our 217.58 and multiply that times 0.97, that'd give us 3% below. If we put a stop at 211, then how much are we risking? Well, we're risking about $1,700. Well, this is an over $1 million account. You might say, well, we're willing to risk, up to $2,500 or $3,000. And so would it meet that requirement? It would. And so if we want to put in that exit to buy back the call and sell the stock, if it goes below 211, we're going to come to market, good till canceled, hit our sprocket. It goes at or below 211.05, we would like to exit. Okay, confirm and send. So we're buying 100 shares of AVGO, selling the 250 call. It's currently trading at 232. We want to buy back the call and sell the stock if AVGO goes below 211.05. And our max gain on this, $2,213. How much could we lose? Well, it's not taking our stop into account. We'd be down about 1,600, and it could gap down. So there isn't a guarantee that we're going to get out at a particular price. But it's saying if AVGO went to zero, that's what you would be out. we're going to put that in our buy right group. Now, if we come and we look at that, let me see. Well, the only buy right we currently have in here is Apple, which is the one we just put on. And so here's one where on Chubb, we sold a covered call, just if we're looking at doing some management, and Chubb has pulled back. So we're currently under to the tune of $938 on the decrease in the value of the stock. It's gone down by almost $10 a share. But this covered call that we sold for at the 295 strike, we sold it for 435. We have 25 days still to go, and it's now worth 45 cents. So might we want to buy that back, given it looks like the stock is up today? So let's come and look at Chubb. So here's our covered call for January. And this is where we're sitting. So how about we decide to buy that back? Now we have an exit on this position. And so what we're going to have to do is come up here to Chubb. I'm going to sort these by symbol. Makes it easier to find. So where we're saying if it reaches a certain level, we'd like to exit. We're just going to cancel this whole order. Okay. And then when we come back to this position on Chubb, we're going to right click, create a closing order to buy back that call for 50 cents. So, net, we sold it for, let me just see. We sold it for over 4. Where's our position? Oh, it's not showing it. Let's go over to the monitor tab. Yeah, we sold it for 435. So we'll have made $390. So it hasn't eradicated the loss, but it's kind of taken some of the sting out of it, hasn't it? It's taken our total loss from 938 to 548. So we are going to buy that back. And then when that fills, could we sell another one? Thea's asking if I can comment on Crocs. I just put a Crocs. My son went to a McDonald's, I'm not sure in which country, and they had little Crocs ornaments. So I have a Crocs ornament on my tree, and every time I see it, I think, don't mock the Crocs. So yes, absolutely, we can look at Crocs. It was on my list as something that could end up turning bullish, and we were going to talk about that in the last class. But let's just finish with this one. So we paid $274 for this, right? And or let's see what we paid for it. We paid $284. So could we come and sell the 285 strike? Let's come and look. So if we come out to January and we look at this 285 strike, wow, they're saying this isn't a very volatile stock either. It's at 20. It's kind of similar to Apple. So this 285 strike, we'd only be paid $1.60 for it. And so what we may choose to do, we have lots of volume, is when we look at this and see it bouncing today, we might say, well, let's look at putting the call on. If it comes back up close to that 284, of adding the call then. Because we've had 3 bullish days in a row. If it keeps moving up, let's put the call on, when it looks like it's going to stop going up. Okay, so here's Crocs, and Crocs was setting up a basing pattern. Could this be a cup and handle? What do you think? What is missing? Let me ask you this. Type it into the chat if you know what I'm looking for here. What is missing from this cup and handle? Here's the cup. Here's the handle. You know, stock is up 20% year to date, and it's gone from 95. Call it, it's almost a $20 move, about $19 to $20 move. What's missing? It hasn't broken out yet. Where's the breakout? Yeah. Chuck is saying breakout. David and Lori, you see, like, you guys don't even need me anymore. You're so good at this. So, you know, would we place that trade today? Yeah, no, we wouldn't, because it hasn't broken out and it hasn't broken down. It's hanging there in like maybe someday land. And do we trade maybe someday? No, we wait. We exercise patience. And geez, like, patience is annoying, isn't it? Yeah. And let me show you a couple of others where, like, I looked at them and thought, oh, this looks like it might be delicious. And then, nope. So here's CrowdStrike, and it's been kind of going sideways. So if you really wanted to own CrowdStrike, could we do this buy right thing? We could. You know, but when I came and looked at the options, first, they're pretty pricey, but you know, we have a lot. And what's with all these zeros? Well, all these zeros are here because they weren't trading at these prices last week. It was just $10 wide strikes. Like here, if you go to February, it's, you can trade the 310, the 320, the 330 only in the front month. Can you trade the, you know, the 250 and the $5 wide strike? So we're just starting to see these come into the fold. And then, you know, do we have tight enough bid-ask spreads? Now, when I looked at this earlier, we did not. You know, do we now? Yeah. And we're at 364, you know, and we're kind of in the middle. Could we sell something in the middle of the road, you know, around 380? But you have to have deeper pockets here because it's a, you know, it's a $36,000 position. Okay. It's a $36,000 position. So what are some other stocks that might be moving bullishly? Well, we could look at the Googs. You know, that's looking like it's moving bullishly if we wanted to practice. How about Meta? You know, and where's that like year to date? Year to date up 69%. That's not too shabby. How about Marvell? Going to the M's here. You know, might there be some possibility there? How about Pan W? I don't know about that one. Where's my concern here? It's like, well, you know, we had kind of a support level around here and it broke it. So I'd be looking, you know, I'd say, yeah, I'm waiting. Now, this one just did a 2-for-1 split. But, you know, when we have so many other really bullishly moving stocks, now, could this be a great opportunity? It could. You know, and some may want to jump on it and some may say, yeah, thanks, but no thanks. So guys, that's a wrap for today. Palantir all of a sudden is like the love child, getting a lot of attention. And you know, and rightly so. I mean, look at this thing is up 370% this year. But is there a possibility to make money on it? There is. And is there a possibility to lose money? Yeah, there is. So as we wrap up this last class for me of 2024, here's what I'm asking. Please hit the like button. It lets me know that you thought I did a good job. It lets Brent know that you thought that what he provided in the chat was of value. And I love it when Brent's there because he always does such a fantastic job. So hit the like button. It also moves this up in the algorithm so more people can find this content. There's also a survey in the chat. And that survey is 2 questions. 1 was I hated it. 10 was I loved it. And there's everything in between. And then you have the ability to type in comments. My commitment to you is that if you type in a comment, Mike Fairborn, who regularly teaches this class, will read it. I will read it. The management team will read it. So you got a lot of eyes on your opinions for what you'd like to see in this class in the new year. I thank you for joining me. I wish you all a Merry Christmas, a Happy New Year. Get out and hug someone you love, guys. Have a really great rest of your day. And I'll see you in a webcast coming up in the new year. Take care, everyone. Bye for now.